Hi, this is John Persinos, Editorial Director of Investing Daily, with a video presentation for Monday, December 20. To view our full range of publications and trading services, visit our website at investingdaily.com. Also, visit the website of our subsidiary, streetauthority.com. Look, here's what you need to know about the Federal Reserve's accelerated tapering. It's already priced into equities. In Wall Street parlance, it's already baked into the cake. The bull market is intact, but brace yourself for prolonged volatility as the rate hike cycle begins. As the Federal Reserve pivots toward greater hawkishness, let's give the U.S. Central Bank credit for at least one thing. It hasn't done anything surprising or stupid, at least not yet. The pandemic has eased from its worst days of 2020 despite the emergence of the Omicron variant, and the economy is back on its feet. The crisis that justified massive monetary stimulus has passed, so it's only logical that the Fed should wind down its balance sheet. Wall Street knows this. However, shifting monetary policy is generating volatility. As the new year looms on the calendar, this uneasiness will be the new normal. The stock market initially greeted the Federal Reserve's hawkish moves last week with a relief rally. After all, accelerated tapering hardly came as a surprise, and in fact, it reassured investors that the Fed wasn't being complacent about inflation. But as investors digested the prospect of rate hikes in 2022, probably 3 of them, the mood quickly soured and stocks tumbled. Take a look at the following table. The technology-heavy NASDAQ got hit the worst last week. That's because growth stocks, especially tech stocks, have higher projected future earnings. When interest rates are rising, those future earnings are worth less. But let's keep our sense of perspective. Inflation is heating up, sure, but the economy has bounced back to pre-pandemic levels of gross domestic product growth at a record pace. We're witnessing the briefest time between the end of a recession and the Fed's first hike. Since 1985, the average gap was roughly 4 years. A rate hike in summer 2022, which has been penciled in by the Fed, comprises half of that time frame. What's more, the 10-year Treasury rate is below 1.5%, the lowest it's been in advance of Fed tightening. Take a look at this chart. Since 1985, 10-year rates averaged 5.3% at the time of the first Fed rate hike. Meanwhile, the Fed's balance sheet assets as a percentage of GDP hovers at the highest since World War II, when the U.S. government borrowed heavily to build up its military machine. The bigger danger to the economy and financial markets would be if the Fed were caught flat-footed fighting inflation. The Fed is now on a path to finish its bond purchase program in Q1 2022. Rather than kill the bull market, I think accelerated tapering will instead herald a new climate of volatility. Huge amounts of liquidity will no longer shore up the market when it confronts new challenges. The U.S. federal funds effective rate was dramatically lowered between February and April 2020. It dropped from 1.58% in February that year down to 0.65% in March, and again down to 0.05% in April. The lowered rate came in tandem with quantitative easing to combat economic damage from the coronavirus outbreak. The rate was set to 0.08% in September 2021 and has remained unchanged since. The following chart, it tells the story. The federal funds effective rate determines the interest rate paid by depository institutions such as banks and credit unions who lend reserve balances to other depository institutions overnight. It's not just the Federal Reserve. Foreign central banks are emphasizing the fight against inflation over the fight against Omicron. Last week, the Bank of England and the European Central Bank took actions similar to those of the U.S. Federal Reserve. Fact is, central bankers in Europe are running out of justification for ultra-dovish monetary policy as economies improve and inflation gets hotter. As 2022 gets underway, investors will be fixated on the rate hike cycle, with stocks spiking up or down depending on signals from the Fed. The rally is likely to continue as economic growth and corporate earnings remain robust, but it's going to be a bumpy ride, akin to the choppiness we witnessed last week. Consider previous rate hike cycles. In the 6 months before the initial Fed rate hike in December 2015, average daily market volatility, as measured by the CBOE Volatility Index, the VIX, jumped 20% compared with the preceding 6-month time frame. The Fed's greater hawkishness is boosting the U.S. dollar. When interest rates rise, it tends to make the greenback stronger. The higher yields attract investment capital from investors abroad seeking higher returns on bonds and interest rate products. The dollar's rise underscores the notion that investors view the strengthening U.S. economy as a more desirable alternative compared to other national economies. But maybe you're looking for an investment approach that reaps big profits regardless of the dollar's movement or shifts in Fed policy. Turn to the proven methodologies of our premium advisory, Velocity Trader. For details, visit the URL that you see right there on your screen. Well, that's it for now. Thanks for watching. Stay invested and please stay safe out there.